Coming up on the SBS On The Money podcast, $50 billion wiped from the boards of the ASX. Oil surges more than 10% overnight and the jobless rate also rises. We'll have all the details next. Hi everyone, welcome to the SBS On The Money podcast for this Thursday, the 19th of March 2026. It's a day with the Australian share market tumbled, the ASX 200 plummeting 1.7%. We'll have the details with Henry Jennings from Markets Today in a few moments. But first, Australia's population has risen to more than 27.7 million. The ABS says that's an annual growth rate of 1.55%, which is below the 1.75% seen a year earlier and under the post-pandemic peak of just over 2.5%. Now, that growth came predominantly from net overseas migration, so that's arrivals minus departures. However, they're down nearly 15% year on year. Natural increase, which is births minus deaths, rose by almost 8%. It would appear, though, that the jobs market is soaking up these new migrants. While Australia's unemployment rate rose from 4.1% to 4.3% in February, there was an increase in the participation rate from 66.7% to 66.9%. And that means more people in or actively looking for work. So what does this all say about the jobs market and what are the implications for interest rates? For that and more, I spoke with Faraz Syed, a senior economist at Citi. Faraz, first of all, how would you describe the labour market given the unemployment rate rose despite an increase in the number of people employed?
Yeah, look, ultimately, we still think the labour market in Australia is quite tight. That unemployment rate obviously ticked up from 4.1% to 4.3%. In fact, we were expecting a surge in employment growth this month in February. You tend to get February to be a little bit stronger as well. You get people coming back into work after the holiday period. So we did expect that pickup in growth to come through. What surprised us a little was just the pickup in the labour force participation rate. So that's why the unemployment rate increased. In fact, we were looking for the unemployment rate to drop down to 4%, but it's 4.3%. It's been hovering around this level for the past, I'd say 12 months or so, between 4.1 to 4.5%. It's been moving around that. And in fact, over the last maybe even 3-4 months, we have seen some evidence that the labour market has actually tightened a little bit more, particularly towards the end of last year. We had strong job growth coming through, and that's, the evidence that we saw the RBA also look at suggests that perhaps the labour market is a little bit tighter than what they initially suspected maybe first half of last year.
What I found interesting is that the ABS made a point today of saying we saw more people move into part-time employment, especially those aged 65 years and over, with fewer people leaving their jobs to retire compared to a year ago. What do you put this down to?
Yeah, look, it's 1 month's worth of data, so you don't want to make too much into, if it's going to be a trend or not. But I think the labour force participation rate has been quite interesting over the past year. In fact, throughout 2025, the labour force participation rate decreased. So by the end of last year, it was a bit lower than where it was at the start of last year. And we've maybe put that down to last year, rates were coming down, inflation was coming down, so the cost of living was improving for a lot of households. And maybe that's why some of those that were marginally attached to the labour force, might have come off the labour force. But as we've seen the labour market tighten towards the end of the year, it actually creates a bit more opportunities for people to come back in the labour force too. And perhaps we are starting to see a bit of an increase in cost of living pressures. Rates are going up, inflation's going up. So you might see again, multiple job holders coming back into the economy, labour force participation rate rising. And it's a dynamic we're actually looking for this year where we think the job growth at least remains fairly solid in the next few months, but the labour force participation rate starts to increase, and that's what actually causes the unemployment rate to increase towards the end of the year to about 4.5%.
This increase in older workers, right? There's still a good story to this, isn't it? A good sign because when it comes to labour supply.
Look, ultimately, if more people are coming into the workforce, whether they're older or younger, it does mean that the labour market is able to absorb them. Right. So ultimately, if we are seeing more people coming to the labour market, we still get to see the employment growth increase, and that's what we have seen in the past, not just this month, but also over the past 6 to 12 months. One of the metrics that we look at a bit more closely is the population as well. If you look at employment to population, that's been increasing again too. So that's suggesting, again, as the population is growing, the labor market is strong enough at least to be able to absorb that increase in labor supply that comes through.
So, how does this all feed through to monetary policy? Does it give the RBA more ammunition to raise interest rates again next time if needed, coupled with those inflation concerns?
Yeah, I mean, if you look at RBA's speeches and their own forecast, they're suggesting that maybe full employment is around 4.5%. So, the labor market is still quite tight. So the RBA will consider the labor market to be tight. They probably won't look too much into the monthly numbers and monthly movements from 4.1 to 4.3. In fact, they look at the trend unemployment rate a lot closer, and the trend unemployment rate actually came down from 4.3 to 4.2%. So the overall trend in the past 5 to 6 months has been suggesting the labor market's tight. So I think the labor market should not be a hindrance to further rate hikes going forward. So what then becomes really important for the RBA is in the inflation profile. And this is where we have a little bit more concern as to how inflation is going to play out over the next 3 to 6 months. Inflation obviously is picking up because of oil prices globally, and that's going to feed into other aspects of the CPI as well. So, for example, jet fuel prices have increased, and that will mean international airfare prices will increase. Some of the transportation costs will increase, and that will feed through perhaps to higher food prices. So it's not just the petrol prices that you pay at the pump, but it's also prices of other goods and services that will be increasing. And, RBA is in a tough position. Unfortunately, we had inflation already outside the target band before we went into this oil crisis. And that just means when you do get this supply shock of oil coming through, the inflation can be compounded higher. So ultimately, we believe the RBA has a difficult job, but they do need to increase policy rates further. So we're expecting another 25 basis point increase, quarter percentage point increase to the cash rate come May Monetary Policy Board meeting.
And you mentioned really briefly before the population data that also came out today from the ABS.
Mm-hmm.
On population growth, there's been a lot of focus on the level of migration into Australia and the impact on the economy. What did today's numbers suggest?
Yeah, I mean, so population growth again was running about 1.6%, and it was driven by net overseas migration as well. So net overseas migration is running at about 310,000 at an annualized rate. You look at where it was pre-COVID, it was about 220,000 on average. So our level of migration is definitely higher compared to where we were maybe 6, 7 years ago. It's a good question in terms of how it impacts the economy. I think in certain parts of the economy, it obviously adds to the capacity constraints. Number one is housing. We have seen housing shortages across the country, so increase in population does add to the capacity constraints in the housing market. But that said, also we do have skill shortages across the country, and so it does also add to the labor supply of the country. So it actually helps keep wages growth a bit more moderate and inflation a bit more moderate as well. Otherwise, we'd be having a lot higher wage growth going forward in some of the jobs, and there'd be a lot of skill shortages, and that would mean higher inflation for consumers as well. So it's a bit of a mixed bag. In some instances, it can add to demand pressures, but then in other instances, it can actually alleviate some of the supply pressures as well across the economy.
Senior economist from Citi, Faraz Syed there. Let's now go to the Australian share market, which had a pretty horrid day. The S&P ASX 200 tumbling 1.7%. That is a 4-month low. $50 billion wiped from the index. So it means it's now down 7.6% since the start of the war in the Middle East in late February, more than many other major share markets around the world. Resource stocks led the losses today, especially gold producers, as the precious metal took a tumble as oil prices surged more than 10% overnight. Tech stocks fell on fears of higher interest rates in Australia, the Australian dollar at 70.35 US cents at the close. For more, I spoke with Henry Jennings from Markets Today. Henry, so the ASX is at a 4-month low. To what extent is the war in the Middle East impacting investor sentiment?
I think, Rich, to be honest, every extent at the moment is being impacted by the war in the Middle East, and certainly the ASX has been a casualty of that. We are, as you say, at a 4-month low, and it is very much a case of the higher the oil price goes, the lower the global equity markets will go. The US has been relatively, I guess, untainted to some extent. We have led the way, unfortunately, I guess, because we're more resource-based, and also we have seen, good gains over the last year or so in some of the resource sectors, which are coming under that serious pressure at the moment. So a combination, I guess, of the RBA raising rates and what's happening in the Middle East and the oil price really hurting our market at the moment.
All right, so that oil price jumping more than 10% overnight, back above 110 US for Brent. These are huge swings. It's not like it's 1%, 2% one day. We're seeing these double-digit swings, right? How's all of that flowing through to investments in the market?
Well, it is, the oil is the blood that flows through the global economy's veins. And the higher it goes, as I said, the lower the equities markets will go. And there is a risk that we could really spike. And every headline, the dramatic headline of various attacks on various oil installations in the Middle East, it is playing into this. And there's a lot of fear and greed. And certainly, there's a lot of commentators talking about $150 to even $200 oil and the effects that will have on the global economy. So there is this shudder that keeps going through the market. And despite what the US and others are doing in terms of strategic petroleum reserves releases, it's really a drop in the ocean. And until we get some resolution of this current conflict, I think we're going to see the oil price continue to spike at times on news higher.
The higher oil price will likely feed through to inflation. I just spoke to Faraz Syed from Citi, an economist there, about the unemployment rate jumping to 4.3%, while the jobs growth remains, which is pretty interesting. But how is all of that flowing through to future interest rate move expectations here in Australia from the market?
Well, I guess last night we saw the Fed keep rates on hold because they just didn't know. Here, of course, the RBA has been fighting inflation, and we already saw that. One of the reads in recent months, 3.8%, really opened the door to the RBA raising rates. We saw that yesterday. I had thought that they might put things on hold because of the uncertainty, and certainly fighting inflation caused by the problem of the oil price spike is going to be problematic, because what happens if oil goes to 150 and we do see 4.5%, 5% inflation, which is quite possible? Where does that put interest rates? And interest rates, of course, feed through into the economy big time in terms of rent, in terms of housing. It's kind of a spiral, unfortunately, and it's hard to break that spiral unless you just sit back and hope and wait, I guess, and be patient to see how things settle.
You mentioned there the US Fed holding interest rates over there at 3.5% to 3.75% overnight. That's still above Australia at 4.1%. While the Fed suggested one more interest rate cut is to come in the States later in the year, does the market believe that?
I don't think so. I think, the market was going for 2 or 3 rate cuts this year, and the market has really been working off the basis that Donald Trump wants interest rates down. But when you look at the US economy, okay, there is still inflation there. It's stubborn, but the US economy is going pretty well. We haven't seen that the jobs deteriorate to a vast extent. So you could argue that there's no real reason for the US to cut rates apart from the wishes of the president at the moment. And clearly, Jerome Powell is urging on the side of caution in terms of those rate cuts. And of course, there is the uncertainty still of who is going to be the Reserve Bank chief going forward as Jerome Powell finishes up in May. We still have yet to get official confirmation or even nomination of Kevin Walsh for that particular proposal for his position as the Fed chief.
So with all of this in mind, what are you telling your clients and where do you see the opportunities for investors?
Ricardo, there is no doubt there's going to be some opportunities. I think investors have to be patient. They have to try and not panic on days like today. It's easier said than done, of course. But I think that you have to kind of look through the current turmoil, the noise, if you like, but certainly be patient. There is no rush to buy this market. It is hard to see a clean, clear-cut end to this current conflict that presents that massive kind of, the V-shaped recovery. I think we're not going to get that V-shaped recovery that we've seen in past conflicts. Happy Christmas, the war is over, and then off to the races again. I think it's going to be more complex, more complicated, and certainly more convoluted. And this oil story, the infrastructure takes years and years, decades in some ways to build. It's destroyed in a millisecond, and it takes a long time to rebuild that capacity and that confidence again.
That's Henry Jennings there from Marcus Today, and he wraps up the podcast for this Thursday. Give it a rating and review wherever you listen to this podcast from. Click subscribe, and there's more tomorrow. See you then. This SBS On The Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.